Okay, sweet. All right, morning, everyone. So my name's Paul. We are going to start the leveraging finances and raising capital microtribe call here. Today we have John White, who is a GoBundance Champions member and has been third generation insurance specialist since 2008. So he's worked with a lot of people like in GoBundance specifically. I'll let him share names if he so chooses, but regardless, just a number of people within the tribe. And so really wanted to give him the platform to describe more about, what he does, sure, but also what he can do, and also what he's seen people do, and then kind of a case study sort of experience standpoint. Oftentimes I would say that we read some things online or think of things of, oh, I should do that. And so really what my intention is for this call is that, I have a whole life insurance policy that I have used as kind of an unlimited banking sort of concept before, but I just happen to have it because my parents got it for me, right? And so learning the concept of unlimited banking and other things that John will talk about will be great. But I'm really hoping that we can kind of put pen to paper and actually take action on some of the stuff. I know some of you reached out or I've talked to in some passing and you're like, oh, I need to do some stuff or something around these concepts. So hoping we can be accountable and follow through with that. So there's a little short intro for John, but I'll let John kind of add more flavor and color as he would like. Morning.
Yeah, good morning, everybody. First thing I'd say for those who are on live this morning, I understand some of you may not have your best dressed outfit on yet. You may be in your car, but if you can turn your screen on, I would really appreciate it. Seeing live humans on the other side always makes a great difference for energy. So if you can stay muted until you have a question, but just turn your screen on, I appreciate it. So thank you. Just even a few more there is a big deal. Just to be clear, Paul, so I'm on track. Like nothing worse than a speaker sharing who's rambling and going way over time. So what are kind of our cutoff times just to make sure we stay on target?
Yeah, so I would say let's shoot for like a 45-minute sort of piece. If we're all just dying for more, then great, let's extend. But nothing is worse than a meeting that's just overdone, right? Certainly if we kind of wrap up at 8:30, let's call it Central Time, that's also totally fine. I am very, very focused on value, not specific times, but there's kind of the time box. So for everyone, have those questions or thoughts ready. Don't feel like you need to fill the entire time.
Sure. Well, I'll probably even focus on 30 minutes, and maybe we can, leave some good time for dialogue. I'll say this: in 2012, I met David Osborne. I was introduced to him for kind of part of my business. But I was also told that he was kind of putting this little mastermind together. And so when I first met David Osborne, who's a founding partner, it was really with the intent of learning about his mastermind he was working on. And, maybe I knew there's probably some areas I could add value to him. And so that's how I got introduced to GoBundance. The first formal meeting was 2014, and I've been a member of GoBundance ever since. I will be one of many who would tell you that GoBundance has had a tremendous impact on my life personally. So I know Emerge is kind of leading into some of these things, regardless if it's GoBundance or Merge. As a group, who you surround yourself with changes your life. And so I commend all of you just being on here. Hopefully you have a chance to meet more champion members. I think what you'll learn is people continue to be genuine, authentic, and wholesome, and it all works the same. It's just bigger numbers, bigger money, networking, relationships. It's all the name of the game, and learning from each other. So hopefully I make a good first impression for GoBundance Champions. Sure. and you all have a chance to meet many others. Almost everyone else in the group is smarter than me, so I'll set the bar kind of low, but I do know a little bit about life insurance. I'll start out with this, and I don't know what everyone's background is in life insurance. There's nothing more boring in some scenarios, and then yet there's nothing that can be more unique and kind of sophisticated when you kind of dive into it a little bit deeper. And I would say when I started my career in 2008, I am actually a third generation in this business. My great grandfather was actually in this business as well. But when I started in 2008 and I would meet somebody and I would begin to teach and educate around some of the sophisticated concepts of how wealthy people have utilized life insurance, I got one answer in response more often than any other answer. That one answer was, John, if this is such a big deal and so valuable, how come I've never heard of it? And that was like a common theme. Smart, intelligent, sophisticated people. Even David Osborne at the time is like, why, how am I just now hearing about this at 40, 50 years old, 60 years old in some cases? I will say 15 years later, I never get that response. I never get that response because of Instagram, YouTube, and just the way everyone's connected and intertwined in groups like this. So I have a couple slides, but a lot of this I'll just kind of talk high level and we'll kind of dive into some things. But now the challenge is not saying, hey, Jason, you may have never heard of this before. Let me teach you something that no one knows about but me, which is not the case. It's more of how do we decipher through all the clutter that exists? How do we know what's real? How do we know what's fake? What's oversold? I'm in the life insurance business. My biggest insecurity throughout my career is I never wanted to be that insurance guy. And so I think I've been successful because I try to be the opposite of that insurance guy. And my degree is not in business or insurance. My degree was in education. So I take a very kind of teacher format. I think you all are smart people. You're smart individuals. I'd say all of my clients are smart and sophisticated investors. When you understand how some of these concepts work, then you can understand how to apply them. So a lot of it's just kind of just from a teaching background. I'm gonna share this slide first because this comes up. This comes up all the time. Can everyone see? This says marketing buzzwords. Can everyone see this?
Yeah, we can, or I can.
Okay, I don't know. Maybe some of you have never heard of any of this. I get emails once a week that says, hey, yesterday, I heard about privatized banking. Do you know anything about that? I heard about cash flow banking. I heard about having a cash war chest. I heard about, infinite banking is kind of the oldest term. Most recently, specially designed life insurance contracts. Usually this is an advisor who wrote a book who says, I've done all the research, I found the best way, and this is what I call it. Life insurance retirement plan, LIRP. There's no product called a LIRP. That is a life insurance concept. So cash vault, family banking, becoming your own bank, living your life insurance. All of these are great books. The bank replacement strategy. All of this are great terms. Honestly, they're all the exact same thing. If I could kind of boil it down in a nutshell, what they're all referring to. Has anyone heard any of those by chance? Just for those that have a video, you put your hand up, right? So they all sound a little bit different. They all sound a little bit extra unique, a little extra bit, a little extra corner on the market. Ultimately, when it comes to life insurance as an asset, by design, there's a few different ways to do it, and everyone's situation is different. There's a few companies that are great, and most companies are not very good. There's a few advisors that are great, and most advisors are not very good. Okay, but in concept, you're looking at having capital accumulate inside of an insurance policy, which is actually a contract. So an insurance policy is a contract. We're accumulating capital inside the product, and then that product is going to earn credited interest. That interest, by the IRS guidelines in Rule 7702, that interest can accumulate and compound tax-free on an annual basis. So in concept, that is what all of this is how do we accumulate, be accumulation-oriented, utilizing life insurance and accumulation-oriented structure It's where we can grow money tax-free, and then we can use it along the way by borrowing against it. You can pull income from it in the future, that can be tax-free, but in concept, it's I'm accumulating money, putting money at work in a tax-free manner, because my interest I'm being credited is not taxable interest. So corporate bonds are taxable interest, T-bills are taxable interest, I-bonds are taxable interest, CDs, all these are great cash assets right now, by the way, but the interest is taxable. I'll go into that a little bit more. So if we're accumulation oriented, meaning less life insurance and hey, I need a bunch of life insurance oriented, but more accumulation oriented, the strategy is that you want to have the least amount of insurance possible to hold the amount of money we want to fund. Think about this for a moment. When we say we want the least amount of insurance possible, that means lower costs. Lower costs means higher net return, higher net accelerated return. Lower insurance costs means also lower commission. So when an advisor structures the policy or the product properly, they are also choosing to decrease their commission to create more value to the plan, more value to the policy for you, the policyholder. Okay. Early on in my career, I had a great mentor. It's a little bit of a leap of faith. It's like, hey, if my grandfather, I'll say this, my grandfather said, you take care of your clients will take care of you. So you're decreasing the commission, better for the policyholder, higher net return on the accumulation side. My experience has been that increases business. People put more money in over time, and I've had a successful business by having this model. But most advisors have scarcity mentality, like most people, and they're not designed to be optimized. And so, but in concept, it's least amount of insurance, put in as much money as we can within this tax threshold called a modified endowment contract. We want to stay within a threshold where all the money out can be tax-free. We do that by decreasing the insurance, and even internally, you can actually decrease your commission even more. And so a simple sign, when you look at a policy, or if someone presents you a policy, you should have a minimum of 75% of the first year premium is cash value. So if you put in $100,000, we have at least $75,000 of cash value. In some cases, you can get these numbers up to 90%. If it's less than 75% of cash value, that is a sign that the cost of insurance is higher than it has to be. And it may or may not be commission driven, but regardless, it's not as efficient as it can be. Okay. So just kind of giving you a little bit of something to look for there. Okay, I'm gonna kind of walk you all through some slides, but in concept, all of these marketing terms are the same. They're all just different ways of getting someone's attention, and they're all great concepts actually, but it's really all to simplify the same thing. Here's what we're really looking for, these next two slides, to kind of give you a visual. Safe money rates today are much higher than 2 years ago. So let's just compare. If you have a T-bill account or a CD or even other safe money rates today, and let's say you can earn 5%. We're really getting close to being able to earn 5%. I think there's like an Apple checking account now that pays 4%. Let's say you earn 5, which would be fantastic. And let's say we earn 5, which is kind of historically low in the insurance arena, and it's going to rise as interest rates rise over time. Let's say you earn 5 on cash and you earn 5 from the insurance company or the insurance product, regardless of company or strategy. The 5% on cash, we're paying ordinary income tax on that interest every single year. So if I earn on 5% on $1 million of cash, and I know these are probably higher numbers than where most people are currently, 100,000 of cash, 50,000 of cash, same concept. That's 50,000 of interest, and then we're going to get a tax statement at the end of the year, and we pay tax on that interest. So we're really not earning 5, we're really netting closer to 3. Does everyone follow me there? So no matter, even as rates are higher, there's still a tax bite. That's called a drag of taxes. If we can earn 5% tax-free, Now we're truly compounding at 5%, no drag of taxes. In the real world, that feels like we just earned 7, 8, sometimes even 9% interest on a money market account. Does everyone follow me? Okay, so just because we remove the tax bite of the interest. So there's all kind of like hidden costs in everything that we do in life. The number one biggest hidden cost or biggest expense we pay over time is going to be in taxes. So yeah, it's not super sexy. It's not 20% return, but you can see here on a $1 million over a 25-year period, that's $1.2 million that we save that can be not just going to our net worth, but we're going to use that money to build wealth in other places. Right, that's not $1.2 million of lost earnings that we didn't compound. So there's opportunity cost of that tax bite is way greater than 1.2 million. Is that fair to everybody? Does everyone understand that? If you're in Emerge or you're in GoBundance or you're in Champions, most likely it's because you're interested in building financial freedom where you have some control. And that means the more capital we have access to, more money we have control over, more money that we're able to put at work. I always tell people it's fair. We all have to pay a certain amount of taxes, but any dollar that I can have control over, I want to have control over. So this is just simply comparing the interest rates of the two options. But here's kind of the big concept here. Infinite banking is, I'll dive into that a little bit deeper, but think about it as the goal of uninterrupted compounding or infinite compounding. So we have the same $1 million in cash earning 4%, and now we go to take $400,000 out for an opportunity. This is the same if we have $100,000 in cash and we take out $40,000, or we have $50,000 in cash and we take out $20,000. We no longer have $1 million earning taxable 4% interest. We now have $600,000 earning 4% interest. This is another space of opportunity cost. Obviously, our 400,000 or 40, we're putting somewhere, hopefully at a 20% return. When I first met David Osborne, he's like, why do I care about 4 or 5% interest? I get 20% on my deals. It's like, exactly. So does every other client. We're still going to get 20% on those deals or those opportunities. But now we have 600,000 earning a taxable 4% while we're making money. And then we make the money and then we put it back, and now we fill our bucket back up to $1 million. But that opportunity cost of no longer compounding on 400,000 is the real cost. That's the real loss in future wealth building. Does everybody follow me? If we have money in really any asset, this is really true beyond life insurance. This is true for brokerage accounts as well. But instead of taking 400,000 out of our policy, let's just say we're earning 4% here in the policy. Instead of taking 400,000 out, we borrow against it. We borrow $400,000. For people who are new to understanding money, they'll make a statement like, why would I borrow from myself? I'm loaning from myself. I'm paying interest to myself. Here's why. And here's why wealthy people are constantly loaning against their assets. We have $1 million in cash. We pull 400,000. We're not taking it out of the asset, not out of the policy. We're borrowing against it. We're still getting our $400,000 deal or $40,000 deal, but we're still earning the 4 or 5% interest on the full 1 million the entire time. We have a loan. The loan, for simplicity's sake, let's say it's also 4% interest. So we're paying back 4% interest. So our interest is a wash from what we borrowed to what we were earning on the 400,000, but we didn't disrupt the compounding of the full 1 million. And so we got infinite compounding on the 1 million. We've got the 1 million earning tax-free interest, and we still got the deal. So, and I think here's what I've learned. Here's how you think about life insurance, and here's how I've experienced wealthy people and how I think myself. Anytime we can have $1 work in 2 places at one time, that's leverage. You can even have arbitrage on these interests. You can even have what's called double arbitrage of earnings. But in simple terms, if I can have $1 over here earning interest and over here earning interest, I have double leverage on that $1. The way you do that is you're borrowing against that asset and investing in another asset. This really is no different than I have a real estate property. I cash out, refinance, take out that dollar, and I buy another property. I now have two properties on the same dollar. Everybody follow me? Home equity line of credit. I still got my home. I still got my asset. I didn't lose it. I've got that dollar out of equity. I'm doing it somewhere else. You can have an investment account, $1 million in a brokerage investment account. It's much smarter to borrow against it, invest that money somewhere else, than to sell and pay capital gains tax on equities. So this is not exclusive to insurance. This is really more of a money concept of keeping money in motion. And as David Osborne has been a client for many years, and many of kind of the founders of GoBundance, I know more about life insurance than those guys, and I help them in that area. But I've learned a lot from them. And one thing I've learned from them along the way and from other clients is they keep money at work in motion, and $1 working in multiple places. And that's a concept of double leverage and this is not unsecured debt. This is debt borrowing against your own asset. Does this make sense with everybody? So life insurance in terms of what we're discussing here, it is a bucket. It is a place. It is an alternative for, when done best, in my opinion, it's an alternative for cash. So life insurance is not an investment, it's an insurance product. And it's an alternative for cash because we can have our principal, our cash value can be guaranteed. So meaning we have $100,000 of cash value, we have $1 million of cash value, and the market drops 40%. These insurance companies, top rated insurance carriers, will guarantee that principal, that it cannot go down. This is huge. In 2020, in March and April of 2020, for 2 months, I had 10 Zoom calls a day with clients, and clients are nervous and optimistic. More nervous though, because the government's telling them you can't evict your tenants who aren't going to pay you rent, at least for a period of time. And so they're asking, hey, John, how much cash value do I have? Because I may need it to float my properties. If I don't need to float my properties, I may have an opportunity to invest in the market and buy a bunch of assets from people who are not capitalized. And when the markets dropped 40% in 30 days, that cash value did not move. It's rock solid. This is why major banks look at cash value as a cash asset. It's why when you fill out your personal financial statement for a loan, you probably have never really paid attention. The top left corner, it'll say checking, savings, money market, CD, cash value, life insurance. This is the column that balance goes in. So a lot of guys are filling out their one sheets. They'll email my team if they aren't logged in online to see and say, hey, what's my cash value balance? Because that's a part of their cash liquidity source. All right. And the whole point is we're getting more leverage on that dollar. So if it's in cash, it creates liquidity for us, and that's it. If it's in life insurance, it's creating tax-free interest. We're removing the tax bite. It's also a liquidity source. It's also inside of life insurance, so it's protecting our family or beneficiaries or debt that we have, or business partners, and we're going to leverage that money up for generational wealth. And we've got the ability to pull money for a supplemental income in the future on a tax-free basis. So that $1 is now working for us in 4 or 5 ways that is not in addition to how it would work for us in a regular cash account. And the key is we're not missing out on deals. We're still using it for deals. That's a big thing to understand. Anytime someone says, well, John, but I can do better somewhere else, that's just a sign to me they don't fully understand it yet. If you fully understand it, yes, anytime you can do better, you put it somewhere better. If a money market account starts paying 12% interest and life insurance companies are paying 6 or 7, then we put it in the money market account. We just loan against to put in the money market account. Okay. This is not, that's not likely to happen, but in a hyper inflationary environment like early 80s, there could be a window of time that just moving it into a money market account could be better. But it has to be twice as good because you still have the tax bite, right? We still have the tax bite. So that part is important.
John, there was a question in the chat, just to give insight in terms of like who's paying the interest on the insurance that Chris said.
Yeah, yep. The interest on the insurance, well, let me back out here real quick. Typically speaking, In a whole life contract, the interest is being paid as by a dividend of a mutual whole life carrier. So the insurance company has a $100 billion, $200 billion portfolio that they're investing with a 100-year time horizon, and then they credit dividends each year. That's where the interest is coming from a whole life contract. There's something known as an IUL, Index Universal Life. It has a different mechanism of crediting interest. There's also what's known as a variable universal life, which acts more like a mutual fund type of investment. It's not a mutual fund, but it acts like that. So it could be negative interest or it could be 25% interest. But usually in the concepts of all the clutter I put up there, they're referring to whole life companies. And I'll kind of walk you through a couple quick slides that'll kind of give you some of that, kind of answer some of that question.
Yeah, cool.
So these are in my research and all of the people that I ever meet with, I think this is an unarguable dispute. So these are the top 4 whole life carriers when it comes to size, credit rating, and dividends that they pay out, are the top 4: Northwestern Mutual, New York Life, Mass Mutual, and Guardian. They're not the only solid whole life carriers, but they are the top 4 in terms of size, stability, credit rating, and banks. When banks are putting their tier 1 capital, this is kind of a whole nother discussion, but when they're putting their money in insurance companies, they're looking at mainly these top 3: Northwestern Mutual, New York Life, and Mass Mutual. I'm contracted with every one of these carriers, including Northwestern Mutual. Most people are probably contracted with Mass, Guardian, Penn Mutual, and Lafayette is what we see the most. You have to have a special contract to be contracted with Northwestern Mutual and even New York Life, but I'm contracted with all of these. They're all great companies. There's certain factors that make one of them or 2 of them a better fit for certain clients. So if someone is only, that doesn't, so an advisor may do more business with one carrier than another, and there's probably reasons for that advisor's business why they do that. But ultimately, an advisor should be talking, or at least mentioning, or at least giving some education on really all of these carriers, in my opinion. Penn Mutual and Lafayette Life are 2 great companies that are much smaller. And there are times where they will issue a policy on an individual that these other top companies might not issue a policy on due to health classifications and health challenges someone may have. But these are dividend payouts from the general account, to answer that question that was just given. And then that is received as credited interest. And then we have insurance expense. So a dividend rate payout could be 5%, 5.5%, or 6%, or even 6.5%. But a bulk of that dividend can go to expenses. So it's really all about how much do you net of that dividend. And I'll kind of show you guys an example here. You could take a quick picture of this if you want to. This is sort of a simple breakdown of kind of the 3 different products, if you will. Not one is necessarily way better than another. They all can be done great, and they all can be done terrible. All right. People often are miscommunicating each one. I think it's key to understand where each one fits into your plan. But in the terms of what we're describing, accessing capital, using it along the way, stable money, top rated insurance carrier, usually that's in this whole life column, is kind of the approach that someone is using. Bear with me here just one second. I'm kind of okay, let me back out of this. I'm going to share an example with you guys real quick. This is someone who has a fully paid up policy. So I'll explain this as we kind of wrap up here. This is a client of mine. It's someone who is connected to GoBundance. Their cash value today is $4.2 million. This could be $42,000. So don't let these numbers be overwhelming. It could be $420,000. This is $4.27 million of cash value. They have cash in the bank as well. They have money earning 3% and 4% interest today that is taxable interest, liquidity, operating business accounts. They have cash in other places. This segment of their cash or capital, their liquid capital, this 4.2 million is inside of a Northwestern Mutual life insurance contract, life insurance product. It's fully paid up. There's no more premiums being paid. That 4.2 million is being credited 5% interest this year. There's other insurance companies that might credit 5.5, might credit 5.7, but I'm going to show you what really matters is the net. So this 192,647, that is the net interest earned. So this client, when I meet with them, I say, hey, you're $4.2 million backed by a AAA rated company. Think about Silicon Valley Bank. There are no AAA rated banks. Backed by a AAA rated financial institution, is crediting them 5% interest, but the gross rate really doesn't matter. It's what do you net? 192,000 of interest is 4.5%. That's 4.5%. There's no tax paid on that 4.5%. So for this client, that feels like you really earned about 8% interest, paid the tax and net 4.5. Does everyone follow me? Okay, and this is uninterrupted compounding. So now they can borrow against the policy. This client is always keeping money at work. Always, you can borrow 95% loan to value. So 95% of that 4.2 can be out at work in another place. If this client passed away, I'll just say, if this were my policy, if I passed away, my family is not going to get 4.2 million. They're going to get, in column 1, 9.8. That's a $5.7 million spread, and there's no tax on that spread. There's no income tax on that spread. There could be a state tax on that spread. If done properly, there would be no estate tax on that spread as well. Okay, so we've got money in our cash balance sheet, personal financial statement, top left, 4.2 million net earned 5%. The net earning is all that matters. And then that money is going to compound and they're going to keep going. If we fast forward another 30 years here, that 4.2 is compounded to 12.2. That's $8 million of compounded velocity on non-correlated money in the market. No market risk, never downturns, never negative interest. That's $8 million of interest without tax. There's no bite out of that tax, or no bite of tax out of that interest. Over this period of time, there's going to likely be hundreds of million dollars of wealth generated off of that capital by borrowing against it, investing in other opportunities. And then when this individual passes away, again, the family or beneficiaries of trust are not going to get 12.2. They're going to get 15.4. There's going to be a kicker. The kicker of death benefit is greater early on. It kind of gets smaller as we get older, but it's always greater than the cash value. Okay, kind of a little different scenario. Example 2 is another client. They have a fully funded, fully paid up $225,000 of cash value. This might be a little bit more kind of where you all begin to think about the beginning stages from a goal setting for you guys. Let's say this client's earning 10,000 of interest on the 225. So 4.5 of interest, tax-free interest, uninterrupted. And then someone wants to flip a house. Paul, you call me, you need a hard money loan. I send you a hard money loan. I'm borrowing against my cash value at a rate that the insurance company is crediting me. Or I could even borrow from a bank potentially at a lower rate in most scenarios. I could borrow against my policy, Paul, I give you the hard money loan and then you're paying me interest. So now I'm earning interest on the hard money loan and my 225 is still earning interest. If this were in a checking account, I'd have to pull money out of my checking account and then give you the interest. Another component is in most states, this is creditor protected money. It's not subject to lawsuit. In the state of Texas, it's also bankruptcy protected. A few other states are 100% bankruptcy protected. So we have clients who are using this money, flip a house, make $50,000 on the house, put the money back, never uninterrupted compounding interest. Okay, this is not the wealth creation tool. This is the preservation and the liquidity alternative to go create the wealth.
John, is there so for context, and there's a couple of questions here, but I'll keep it concise. My parents
I'll just say this, Paul. I'm pretty much wrap up on sort of those nuggets, and we can just
Okay.
kind of talk through questions.
Yeah, sure. Cool. Sounds good. Good segue. So, my parents got a whole life insurance policy for me when I was like 12 or so, right? Kind of got conned into it, but it is what it is. And so, it's not set up like officially at it. Really what my question is that a couple of years ago, I then, did a withdrawal, of those funds, and not a loan. So, throughout this, and I just wanted to like kind of separate the oil from water here in the sense of like it is more advantageous to take a loan on it than kind of take out the cash value, because then the cash value isn't accumulating interest. Or can you explain more about that?
Yes, there's always math responses with money, and there's emotional responses.
Sure.
Okay. Mathematically, it's always going to be better to take a loan, especially if we have cash flow in resources. We know we're going to pay the money back. We know we're going to cash flow the money back. Not because we necessarily have to. You really don't even have to, actually. But just for velocity of compounding, we want to take a loan and use it. But let's say let's say my child is going to go to college, and I want to pull some, I'm going to pay for it out of cash flow. But let's say I want to, I've had clients use cash value for cash flow management, and they're writing a $40,000 check for college. It'd be better to borrow against the cash value, write a check to the institution, and then we got more cash flow coming, we just cash flow back the loan. But they could say, hey, I don't even really want to deal with that. I don't know if my income is really going to grow much more. I just want to take a distribution or withdrawal of my cash value, write a check, and be done with it. At some point, the simplicity can be better. At some point, not having concern of, am I going to pay it back? When am I going to pay it back? You don't actually have to pay it back in most scenarios if it's done correctly. But mathematically, the answer would be yes. The answer would be yes. I do have a client who's 67. He understands his policy. He got it in 1980. He actually said, this is his words, the best investment I've ever had. He's done private equities and other things, but he's gotten an 8% return on his money tax-free. Now, it's not an investment, it's an insurance product, right?
Sure. Yeah.
But he says, hey, just send me my dividend as income. And I tell him, like, hey, you'd be better off if we loan that value to you. It's tax-free, but his dividend is also tax-free right now. He's like, I don't care. I've got plenty of money. Just send me a check. Right. So there is a point of, people will, I think, oversell using life insurance as a major part of retirement income.
Sure.
It is absolutely a source for retirement funds, no question about it. But it shouldn't be this major source of tax-free money, in my opinion, because I think that's oversold and we can be over-dependent. It's a supplemental, especially like in 2022, 2020, 08, 09, 10, 11, when the markets are down, it's one of the best places to pull. When you pull, it's strategically better to do a loan. You might have enough money at that point, Paul, and you're just like, I don't really care, just send me a check.
Sure.
And that's fine too. That's a very peaceful place to be.
Yeah.
But mathematically,
No,
a loan would answer your question.
Cool. No, good to know for the next time I have policy amount for that. All right. So Kyle asked, how old is that policy and what was the premium outlay to start for, kind of some of these examples you gave?
Yeah, absolutely. And just for sake of time, I could do this again, or we could go more one-on-one. I mean, going through a schedule, this is really a seven-year plan. And so, but I want to kind of give you the visual of what the end result should be and the reason why you do it. Okay. That policy that was just shown was funded for 7 years. The cash value, the premium was $500,000 a year for 7 years. And one portion of that, they put a little bit in for year 8. And so there was about $3.7 million put into the policy starting 7.5 years ago. And now that's 4.2. And then that money is going to compound for the next 50 years.
Sure.
Okay. One thing to think about, this is very different with life insurance than any other asset. This is a minimum. I don't know how the oldest person in here, if you were 60 years old, I'd say the same thing. This is likely at least 50 years of a decision. Okay. So who you work with as an individual, and probably more importantly, who you work with as a company, is a big deal, because it's a 50+ year time horizon before that life insurance is hopefully ever paid out. at a minimum. Does everyone understand what I'm saying? So people will get caught up in a little bit of like, well, who had the highest dividend this year? Or who's the highest dividend last year? And a lot of advisors will sell whichever company is marketing the highest dividend that year. You should be looking at the last 50 years of track record, and really the last 150 years of track record. Because I'm 39 years old, I'm hopeful that my policies never actually mature for another 60 years minimum, right? And I think that's something people overlook. If I work with a client, I'm probably not doing their meeting in 60 years, but I'm gonna be doing it for a long time, right? If anything unexpectedly happens in the next 30, I'm probably gonna be the guy overseeing their family. But so I have a lot of confidence as an advisor. I typically use those top 3 companies that we mentioned because those are the biggest, strongest financial institutions in the country. And I have a lot of faith as a client that as an advisor that a client is going to be okay with those companies, even when I'm not here.
Yeah, you bet. Chris, I'll kind of punt your questions just because they can be very specific and detailed, and want to make sure you get kind of the information you're looking for with loan to value and just accumulation versus kind of dividend. And then Kyle has a question of like, what should someone ask when talking to an agent? Definitely a potentially long-tailed question. I would think it would just be kind of that trust and that knowledge is really where it starts from. And then asking the right questions, giving them the right information to know what path you're headed. Anything else that you would kind of add on that, John?
Yeah, I would ask a couple of questions. If someone has a podcast or a book, there's a sense of authority in the marketplace. That may be true, that may not be true. There's some great salespeople, great marketing people with podcasts and books of all industries, right? Same is true for real estate. I would ask people, how long have you been doing it? How did you handle down markets when I needed to adjust, when people adjust their premium? So how long have you been doing it? How have you handled challenging years with clients? What are some of the largest policies you've written? And who are 3 clients that I could speak to? And obviously they're going to introduce you to some of their very best clients, right? But I think kind of asking people like, hey, on the back end, what is the real life experience like with these policies? If you can speak to people in Emerge or GoBundance and kind of get their impact, or really if there's mentors, if you have mentors that people have used, individuals, I think that brings some authority too. Another question I think is great is like, what is your business model? There's a lot of people today that the insurance component is just a piece of their business, and they're really doing a lot of other things. So they may not be as up to date with all the changes that go on. Another maybe how many different companies do you use? How do you decide what company to use? I think these are all good questions. At the end of the day, if you've spoken to 3 people who are raving about someone, that's a pretty good place to start. Pretty good place to start. There are some companies, I'll touch on this just a little bit. There's what's called direct recognition and non-direct recognition. Okay. That's how they treat their dividends. I think it's one of the biggest misunderstood things in the marketplace. So some companies, your dividend stays the same if you take a loan. Some company, the dividend can change. It's almost always communicated that it's better for the dividend not to change. We're in this example right now. Some of those companies I just showed are direct recognition, some are non-direct. I think it's just important to understand how it works.
Sure.
A direct recognition is actually inflation protection. So a loan interest from an insurance company can actually be higher than the dividend. When interest rates are really low, this is not really a factor. But when interest rates, we're in a hyperinflationary period, and it looks like interest rates are going up. So if that dividend is trailing rates and your borrowing rate is higher than the credited dividend rate, you actually could be a little bit upside down on your loan versus what you're earning and what you're paying in the loan. Does that make sense to everybody? So some companies, a direct recognition company, they're going to actually credit you the interest that you're paying. So I have clients right now who are earning more interest on borrowed funds than what the insurance company is normally crediting on unborrowed funds. It's the biggest misunderstood thing that I see. If interest rates are low, Well, that could affect the dividend rate to be lower possibly. But guess what? There are banks across America who are calling me who want to do third-party line of credits against cash value. And so when interest rates are lower, almost every client I have, they don't borrow from the insurance company. They're borrowing from a third-party bank at a lower rate than what the insurance company is crediting, and we can even deduct that interest. So for 10 years, almost everyone's borrowed from a bank. Right now, that bank rate is higher. So borrowing from the insurance company is better in many scenarios, and direct recognition companies are actually going to credit a higher rate. And really what they're doing, this is the biggest misunderstood thing, they're really protecting the client from being upside down on the loan.
Sure.
Does that make sense?
Yeah.
It's almost, I'm not even going to say one is better than the other. I think it's just important to understand, and there's factors. So there's a cost. If you're borrowing at a higher rate, there's a cost there. The direct recognition companies, usually their net expense on the policy can be lower. So a non-direct recognition is the dividend doesn't change. Those dividends can sometimes be marketed higher, but the cost of insurance can also be higher. So the net is going to be a little bit lower. Here's what I tell you with all these companies: if you have a well-structured policy with an advisor you trust, you could do a policy with about 6 different companies, and if you fast forward 50 years, my guess is the average return is within about 50 basis points of each other. It's really more about the structure of the product. Is it designed for the least amount of cost of insurance? And is it designed where you can access the capital you need to do the deals that you want to do? And then do you have an advisor team that you feel comfortable with that's there for you when you need them? Let's kind of get in the weeds a little bit right here at the very end, but I think there's a lot of hype around direct recognition, non-direct recognition, or I've done all the research and this is the best way to do it always. There's almost no statement that is ever true.
Sure.
You know what I mean? I have some client doctors that are in the doc pod. They're like, imagine being a doctor and you tell everyone, I've done all the research, no matter your illness, penicillin is always the answer. Right? And so when you think about an advisor telling you that, I would be wary of that person. Just like someone saying, I did all the research, multifamily is always the best class, always the best asset class, always better than self-storage, always better than residential. Like it's just not true. It is a great bucket amongst the buckets, right? But I just think you just want to be sure that you're kind of understanding and being taught how to think about your own policy, not being sold your policy.
Yeah, no, you bet. A lot of good information here and insight stuff. I didn't know, and certainly by no means do I know everything, but it's been fun to dabble and learn that, hey, I should have taken a loan, 4 years ago, but world goes around. I'll go ahead and share this recording, within the group, and then also share John's contact information. John, really appreciate you coming on, spending time with us. And going to ask everyone to give them a high five virtually. If you're not on camera, maybe give yourself a high five. I found this is the best way to get through a day and continue on. But thanks again, John, and we'll be in touch.
Sure. And I can say, Paul, if you want to take 5 more minutes, people can jump off. I can pretty much answer most of these questions pretty quickly.
Oh, sure. Okay. Yeah. I mean, if there's certain
so
yeah.
I'll just kind of run through them. So who's paying the interest in the whole life is the insurance company's dividend crediting rate. How can you share your contact? Okay.
Yeah, I'll do that one. It was as we get to, so Chris was saying, hey, who provides these loans and what's the typical LTV?
Typical LTV is 95%. Almost every insurance company is worth their salt is going to be 95% loan to value on a whole life contract. Banks who focus in this area who will also do collateralized loans. Like I have clients that have a 5% fixed rate from a bank and they can deduct that interest. Like this is kind of getting a little higher in the level of sophistication of how this can be used. But if you're borrowing at 5% interest and you deduct it, you're really borrowing at 3%. Those banks that are focused in that space are also 95% loan to value as well. And I think banks, if you really understand how banks look at these insurance companies and why they do 95%, it really tells a great story of understanding that this is a cash alternative. They're not going to give 95% loan to value to an investment portfolio or a real estate portfolio. what's the difference between the dividend and accumulated value? So there's a guaranteed interest. So most of these whole life companies are guaranteeing between 2 and 4% interest. It sounds better to have a guaranteed of 4 versus a guarantee of 2. There's actually a little higher insurance expense to guarantee 4. So when the regulators allowed insurance companies to go down to a guaranteed 2, that was actually a good thing for consumers. Now, advisors use that as like a mass selling tool, like get the 4% before it goes away. But the truth is, by having a 2% guarantee, you can actually get more cash value in the product, which is better. So the dividend listed in the column is not the full interest earned. It is the portion above the guarantee up to kind of whatever the stated dividend rate is. Okay, that's really what that number is. So you can look at your dividend in the column, and that's really not what you're looking at as far as your net interest. Your net interest is how much is the cash value going up from year 1 to year 2. That's your gross dividend minus expenses. Okay. A lot of advisors will sell on a dividend rate. That's like me trying to sell a company to you guys. Say I'm an investment banker. I'm gonna sell you a company that's $10 million in revenue. Here's a company over here that's $8 million in revenue. The $10 million revenue company is better, right? Well, it depends. How much money are they making? What's the profit of the companies? What's my net return of the company? But in my industry, most advisors are just touting, this is the top dividend for this year. Let's look at a 100-year track record, and the expense is a big factor. What's the net expense? I've seen policies that are 6% dividend and policies that are 5%, and the 5% is netting almost 100 basis points more. And you calculate that in what is your cash value increase, what is that increase percentage of the previous year's cash value?
Makes sense.
Okay, I think I probably have covered most of these. Just there are a couple that were left.
Yeah.
That's my email, guys. There's a lot of great people in this business. I think, you know, I'm always here to be a resource. I get calls from GoBundance guys all the time, and GoBundance ladies now, hopefully, that they're like, hey, will you just look at my policies, or I've been doing my research and what should I consider? And you know, for GoBundance members, I don't mind kind of giving my opinion. If you've had a policy for really a couple of years, unless it's just really done, you know, I tell people, it's like, unless it's like, man, you got screwed, which if you're working with someone who's talking about these concepts, that's probably not the case. It doesn't make sense to change it. It may make sense to add on another layer that's done a little bit better, but usually when you're a couple of years into it, if it's one of those carriers that I mentioned, it's probably going to make sense to keep that particular policy. Because over 50-year period, those insurance companies are all going to do well, and you've kind of already covered your upfront load, if that makes sense.
Yeah, for sure, definitely.
Okay, well, hopefully at some point at a merge or GoBundance meeting, I have a chance to meet everybody in person. So this was great to be with everybody this morning.
Yeah, you bet. I'm in Austin, but yeah, might make a venture over to you.
Yeah.
Thanks, John.
I'm in Atlanta. If anybody's ever in Atlanta, hit me up.
Sure.
All right.
You
Awesome.
bet. Cool. All right. Well, thanks everyone. Appreciate it. Enjoy the rest of your days. Take care.
Take care. All right.